Let's talk about UnitedHealth Group. In 2025, this absolute titan of American healthcare found itself in a complete freefall. We're talking one of the biggest, most important companies in the industry, suddenly in crisis. But for every crisis, there's always that question, is this the end of an era? Or is this a once-in-a-generation opportunity for anyone brave enough to jump in? Just look at this number, -48%. That tells you pretty much everything you need to know about how bad things got. In just the first half of 2025, the company's stock lost nearly half its value. Now remember, this isn't some volatile startup. This is a blue chip, a member of the Dow Jones. A collapse this big sends shockwaves through the entire market. And hey, don't just take my word for it. The Motley Fool put it pretty bluntly. It's been a very rough year. That's kind of the understatement of the century, right? Okay, so let's get into it and unpack what on earth actually happened here. So first up, how does a healthcare giant even collapse like this? I mean, we are talking about the largest private health insurer in the entire United States, a company that's totally central to the lives of millions of people. How could a company this big, this important, stumble so badly? The scale of this is it's staggering. The stock didn't just dip, it completely cratered, hit a 5-year low. And in the process, it wiped out billions and billions of dollars in shareholder value, seemingly overnight. And it left everyone, from Wall Street pros to regular people, asking one simple question: why? And that question, well, it brings us right to the bear case. See, this wasn't just one thing going wrong. No. This was a perfect storm, a totally brutal onslaught of bad news that was hammering the company from every possible direction. It really kicked off in May of 2025. First, boom, the CEO is out amidst all this market panic. Then, just a few days later, news breaks that the Department of Justice is hitting them with a criminal fraud probe. By the time July rolls around, things go from bad to worse. The company completely misses its earnings targets, and then they slash their financial forecast for the entire year. It was just this relentless, non-stop cascade of terrible news. Okay, so let's break that storm down. You've got massive legal pressure coming from two sides: that DOJ probe into their huge Medicare Advantage business and a lawsuit from their own shareholders. At the exact same time, their operations are getting hammered. Medical costs were surging, up 20% in one quarter, and their key profit engine, Optum, started to sputter. Any one of these things is a major, major problem. All of them hitting at once, it's just catastrophic. Now, to really get why this was so bad, you gotta understand one key term: the medical care ratio, or MCR. The easiest way to think of it is like this. For every single dollar UnitedHealth brings in from premiums, how many cents have to go right back out the door to pay for actual medical care? A higher number is bad news. It means lower profit. Well, theirs surged to almost 90%. That means nearly every single dollar coming in was immediately going right back out. You can't run a business like that for long. But, this is where the story takes a fascinating turn. Because amidst all of this chaos and panic, some very smart investors started to see this sell-off not as a disaster, but as a historic buying opportunity. And that brings us to the bull case. I mean, it's the big question, isn't it? You've got a criminal investigation, you've got costs that are just soaring, a stock price that's in the tank. Why on earth would anyone, let alone the pros, be buying this company right now? Well, the first part of the answer is pretty simple: the price tag. The bulls are looking at this thing called the forward PE ratio. It's basically what you pay for $1 of a company's future earnings. UnitedHealth's PE dropped to under 12. Now, to put that in perspective, investors were historically willing to pay almost 19 for it, and the rest of the market's average is over 20. So in other words, a company that was always a premium brand was suddenly sitting on the discount rack. Okay, the next piece of this puzzle is a metric called return on equity, or ROE. All this tells you is how good a company's management is at taking the money shareholders invested and turning it into actual profit. It's a really crucial measure of how well a company is run. And this right here is where the bull case gets really, really compelling. So yes, the insurance business has razor-thin profit margins. That's just how it is. But what isn't normal is how incredibly efficient UnitedHealth is with its investors' money. We're talking a 27% return on equity. That absolutely crushes the market average. This shows that underneath the bad headlines, this isn't just a big company, it's an elite, world-class, money-making machine. And then you have this. Right in the middle of all the panic back in May, the new CEO, Stephen Hemsley, a guy who knows this company inside and out, went and put $25 million of his own money into the stock. There's this classic saying on Wall Street that just nails what that $25 million buy means. Insiders might sell their stock for a lot of reasons. Maybe they need cash, they're diversifying, whatever. But they only buy for one reason. They are absolutely convinced the stock price is going to go up. It's the ultimate vote of confidence from the person who knows the company better than anyone else. So you have to ask, was this just a UnitedHealth problem? Well, it's crucial to understand that while a lot of these wounds were self-inflicted, the company wasn't operating in some kind of bubble. The entire healthcare sector was feeling the squeeze. If you look at a 2025 outlook from KPMG, it shows that the whole healthcare payer sector, companies like UnitedHealth, is getting squeezed by rising costs and shrinking margins. So UnitedHealth isn't alone here. Their competitors are also selling off parts of their business and changing strategies to survive. This context is so important because it suggests that while UNH's problems are bad, the sickness is industry-wide. So after all that, where does it leave an investor? Well, you're stuck with two powerful, compelling, and totally opposite stories. This is the investor's dilemma. It all boils down to this stark contrast. On one side, you have the bears, and they're pointing to some terrifying risks, a criminal probe, costs that are out of control, intense regulatory heat. But on the other side, you've got the bulls, and they see a massive opportunity, a deeply discounted stock, elite profitability, and a CEO who is betting his own fortune on a major comeback. So what did the pros think? Which side are they on? Well, according to Wall Street analysts that TipRanks keeps track of, the consensus is a moderate buy. So despite this absolute firestorm of negative headlines, the vast majority of experts believe the stock is actually more likely to go up from here than down. And that, right there, leaves us with the ultimate question. Was the stock's collapse just a massive market overreaction to a storm that's eventually going to pass? Or are these deep structural problems the new reality for a healthcare giant that is now permanently under siege? The answer is going to determine the fate of billions of dollars, and it's a story we are definitely going to be watching closely.